Welcome to Trade Ideas. I'm Jake Merl, sitting down with Max Wolff, co-founder of Multivariate. Max, great to have you back on the show.
Always my pleasure. Thank you, and happy holidays.
So today we're going to be talking about central banks, specifically the Fed and the ECB. We have some important meetings coming up. So I wanted to get your thoughts if you think the Fed is actually going to cut rates in their next July meeting.
Yeah, so I don't think I'm alone here, but yeah, I do. I don't think we're going to see 50 basis points. And the reason I think we'll only see 25, and I'm not sure we'll see 2, is we have a very politicized rate environment, which is terrible for the Fed long term. It's not about one regime or another, one party or another, but the independence of the Federal Reserve has been a cornerstone element of the success of the American financial markets really since the period between World War I and World War II. That's tremendously valuable to the U.S., not least to the U.S. government, which is the world's premier debtor by total size of indebtedness, and as therefore the world's premier beneficiary of low interest rates. So lots of reasons not to do what we've begun to do here, which is politicize the Fed over the last many years, but increasingly the last little while, so not so hot. And I also just think that the Federal Reserve wants to have the credible ability to really cut if things get bad, which they're not yet. And if you sort of preemptively slash rates, especially under political pressure, you don't have dry powder for the possible need case in the future.
So you're expecting, a 25 bips cut in July?
Yeah, I think we're going to see a lot of language and a lot of we are watching closely to cut if need be. We might see the sort of strident nature of that warnings come, but I think they're going to try to do more jawboning and less cutting. I certainly would, and just because, especially if you sort of price in, as the markets more than have, a likely 25 to 50 basis points cut, how low are you really going to go here? I mean, I guess you can go 100 basis points and you get to where the 10-year Treasury is right now, which tells you that the bond markets are already pricing a totally different economic scenario than the president needs to get reelected and is asking the Federal Reserve for, and then the equity market investors think they see when we're getting close to record-breaking territory on the Dow.
So Max, we've also seen a recent nomination for Judy Shelton for the Federal Reserve Board. What do you make of that?
Yeah, so we've seen a few. I mean, obviously the Federal Reserve is a weird place to be kind of a gold standard advocate, only because it's the modernization we did to get rid of the gold standard when 100 years of history suggested it wasn't always suitable to the long-term macro goals. Obviously, it's a different world now, but that's unusual. And what gives me pause is nothing about the individual in question. We don't want overtly political Federal Reserve Board governors, right? So it's a two-way street, the independence of the Federal Reserve. The Federal Reserve should stay out of a direct political opinion about what the Senate and White House are doing and the House, and vice versa. So having someone so affiliated with a particular candidate in a political process is unnerving, particularly because Trump kind of rose to some prominence, and in part making some good points, but saber rattling about too low interest rates and how it's a political hustle to have interest rates go down. It's then very hard to put in a political appointee who has a political affiliation with you who wants to cut interest rates. It just isn't great for the independence of the institution.
So obviously, we've seen this huge rally over the past 6 months as the Fed pivoted and got dovish about 6 months ago. And we also saw them re-emphasize that point last month in their meeting, and the stock market bounced off the May lows. But my question to you is, Max, do you think we're going to get the same response going forward? Because historically, when you look back over the past 2 cycles, when the Fed initially eases and initially pauses, you do get this rise in the stock market, but that kind of signals the top. And this is a question I've been asking a lot of our contributors recently. I would just like to get your thoughts if you think it would play out the same way this time.
Yes, it's a great question. Look, I think this market's been trying to correct since 2016. Right, so this is going to be the same story it always is, however unpopular. When you don't let the little tiny forest fires come and clear the brush out, when something finally gets lit and it's hard to put out right away, you end up with a big fire, right? And so we failed the soft constraint. We've now chose the big fire. So it makes it harder to know what you're going to do. But because that's likely, you want more dry powder, ironically. And I think, look, we've gotten to a point of a market expectation where the Fed is being asked to engineer abnormal, unsustainable, above mean market returns all the time. Right? And people have lost the understanding that that can't be done because it has more or less been a bull market for pushing 10 years, right? One of the longest expansions in American history off a really low base. So we're more than 3x the baseline equity performance in a 10-year period, which is not the historical norm. And the bond market's kind of got in on the action, spiking and pushing rates down, which means that somebody's wrong for sure. And it might not be just one party. So look, I think that by the end of 2019, the U.S. economy is already weak. I don't know if it'll be in a recession or not. Very well could be. And I think everybody kind of knows that. And the question is whether you're going to use the stock market as a way to pull the economy out. And given that only about 15% of the country owns any meaningful stock, that's not a great idea.
And so before off camera, we were talking about the Fed funds rates versus the prime rate. Can you walk us through what you were looking at there?
Yeah, so I mean, there's lots of conversation in the marketplace from authorities and market participants and John Q. Public or whomsoever. And I think it's interesting to reality check that a 5% prime rate and a 3% discount rate for the Federal Reserve, we're at or around the lowest rates we've ever had in American history outside of the trough of one or two severe recessions. So yeah, it might have been lower 2 years ago, a little bit lower, but the truth is we are at rock bottom rates. This economy has never gone off the stimulus strip. You know, and ironically, 2 years ago, or 3 years ago, candidate Trump was screaming bloody murder that Janet Yellen had too low interest rates and was politicizing her job, even now with lower rates where he wants the rates cut. So look, I think we need to get into a reality check mode here where we do not have high interest rates, full stop. We do not have interest rates that would snuff out any kind of robust economic expansion, full stop. The average economic expansion since World War II is 6 years and we're 10 years in. So there is no magic that any Federal Reserve Board should be asked to do or can do that repeals the business cycle, and all efforts to do so have ended much more with tears than with cheers historically.
And so I know we've been talking mostly about the Fed, but we also have an important meeting with the ECB coming up as well. And just recently, Christine Lagarde got picked to be the new replacement for Mario Draghi for the ECB. So what do you see going on there?
Yeah, so look, it's always a bit tentative when you come in new. That being said, I don't think you could have made a more calming choice, right? Obviously very well thought of, a good run as finance minister in France, which some in the US don't know as much about because it's less international, but she was also finance minister during their dark days around the 08-09 crisis and proved pretty adept in that role. So I think that gives her some gravitas with Europeans and market participants. Also IMF run that was pretty good, which might reassure people. I guess the issue for some might be that she's less a banker historically and more political creature on some level, but I think it'd be pretty hard to say that interest rates aren't a political hot potato these days, not just in Europe, but really globally. So I think she's quite adept, and I think she's also already committed to keeping Draghi's team. So I think a lot of sort of continuity there. I do think it's always a little bit more difficult, and my guess is the big test for her is she'll probably come in with 1 to 2 quarters of kind of goodwill honeymoon, and then she might be slightly more prone to attacks on credibility if things are tumultuous, only because she won't have the long history in the markets that Draghi had, and she won't have the benefit, nothing to do with her, but she won't have the benefit of having been in there a long time. Powell, a little bit, he's newer, but he's much more settled in, so I think less of an issue there. I also think Europe is much ahead of the US in a weakening macro situation, having never had as strong of a macro situation. So I think more cutting is reasonable there. And I also think that you'll probably see them push more quantitative easing in Europe. They're going to have to. And at some point, not right away. So they have $300 or $400 billion. And then they're going to actually bump up against their own self-installed constraint. And it'll be very destabilizing and interesting to see if they have to give themselves a higher limit for QE. And if they do that, it will be a very negative signal, and it will create some instability between the euro and the dollar as well. And we'll be looking closely to see if that happens. Again, don't anticipate it, at least not for at least half a year or more, but we'll keep our eyes on if we are approaching that.
And so bringing it back to markets, what's your outlook for the S&P 500, given the dovish Fed and the dovish ECB?
Yeah, so my guess is that even though I think things are pretty overvalued right now, my guess is they become more overvalued, and I think we'll probably end up the year at or around where we are now, having gone higher and then come back down. The sort of $64,000 question toward the end of this year becomes, how quickly does the US soften and how well does the rest of the world stand up? And the reason that's so hard to sort of figure out is where we go in terms of the trade disputes with China, how much, if any, sort of forward progress can be made, and whether we can patch things with Europe or whether that disintegrates too into a more hostile situation, right? And then the deep out of the money stuff we're looking at, which is interesting to us, low probability but big impact, is there is a possibility for a rapid weakening of macro in the US. And we will keep a very close pitch on that. And there's also the possibility that the unsustainably low rates, particularly on some of the weaker European sovereigns, could unwind badly. Thinking, but not exclusively of Italy here, a sub 2% seems very aggressive given some of the structural headwinds and political uncertainties that surround Italy in the near term.
So is there a specific trade you'd be looking to put on here, or how do you suggest traders play the current environment?
Yeah, so we actually think the dollar will weaken ahead of the U.S. Weakening economy in the back half of the year, and markets have not priced that. So we're going to look at dollar euro much more interestingly as a barometer of relative economic weakness, and we sort of feel like the markets will be underwhelmed by the rate cuts, and we're also going to look at that for some weakness in risk assets. A lot of folks think that the equity markets will prove right and the fixed income markets will prove wrong. We think the reverse is true, but we think the equity markets will prove right short term, and then even after one quarter or more, it'll be the fixed income markets that win this, and very few people are making that bet, so we'll watch that closely. But if it's true, then risk assets are relatively more overpriced. And last piece I think we need to keep in mind here is that there is a non-trivial possibility of one of these sort of simmering confrontations becoming more aggressive. And if that happens, it will not be constructive for risk assets. And I have still not met a single risk asset bull who has any position on that one way or another, which makes me nervous.
And so how much downside do you see for the dollar over the coming months?
I don't think we're going to see crazy downside, but I think we'll see a lurch downward when we get a disappointing total rate cut in this month, in July. And then I think we might see a little bit of a readjustment of the total rate cuts of this year. I think the best we're going to get is 50 basis points this year. And the only way we're going to get more than that, because the Fed wants some dry powder, is if things really turn down, i.e. the macro circumstance turns down. Doesn't mean recession, but it could mean a real weakening, slowing. And if that's the case, then the extra 25 basis points won't be enough to push risk assets back up.
Well, Max, that was great. We'll see how it plays out. Thanks so much for joining us.
Always my pleasure.
So Max is bearish on the US dollar. Specifically, he thinks the euro will rise 6 to 8% against the dollar over the next 4 to 6 weeks. That was Max Wolff of Multivariate, and for Real Vision, I'm Jake Merl.